Hello everyone. This is in continuation to our topic marginal costing. This is the second part. In this, we are going to solve two different problems. Question number one, a company sells its product at rupees 15 per unit. In a period, if it produces and sells 8,000 units, it incurs a loss of rupees 5 per unit. If the volume is raised to 20,000 units, it earns a profit of rupees 4 per unit. Calculate the break-even point in terms of value as well as in terms of units. So let us proceed. So it is given selling price per unit. In rupees. Then how much quantity is sold is given. Quantity in units is given. Then whether it is a loss or gain is given. So I will write here profit in rupees per unit. Then we will simply write profit in rupees. This is sale quantity. So first of all, they gave us if it is sold at 15 rupees per unit in a period, if it produces and sells 8,000 units, it incurs a loss. So here I have to put minus 5 because it is loss. That means the profit will be minus 40,000. Then if the volume is raised to 20,000 units, they didn't say any change about selling price, so it remains the same. Then it earns a profit of rupees 4, which means the profit becomes now 80,000 rupees. They are asking us to calculate break-even point. So first we will calculate PV ratio. Is change in profit divided by change in sales. So that is 80,000 minus 40,000 divided by change in sales 20,000 minus 8,000. So numerator is 1,20,000. Denominator is 12,000. We will express this in terms of percentage. Oh, I think I made a mistake here. We have to calculate the sale in rupees. That I have to substitute because numerator is in terms of value. Denominator also should be in terms of value. Let me write the PV ratio in terms of percentage. Sale in rupees will become 8,000 into 15. You get 1,20,000. Here 15 into 20,000, we get 3 lakhs. So change in sales will become now 3 lakhs minus 1,20,000 multiplied by 100. Numerator is 1,20,000. Denominator is 1,80,000 multiplied by 100. That will be 2/3 into 100, which is approximately 66.67%. Now, we will find out the fixed cost by using this. Sales is equal to fixed cost plus profit divided by PV ratio, which means, let me consider the second one, 3 lakhs is the same, is equal to fixed cost. For the 3 lakh sale, the corresponding profit is 80,000 divided by PV ratio is 66.67%, which is approximately, we'll write it as 2 by 3 times 100. Then we will cross multiply. We will have fixed cost will be 3 lakhs multiplied by 2 by 3 multiplied by 100 minus 80,000. So that will give us, this is 1 lakh into 2. Let me redo this. Let me put it as 66.67% is 0.6667. Now cross multiplying, we will get 3 lakhs into 0.6667 minus 80,000. If we calculate that, we will get rupees 1,20,000. Now we have fixed cost available. We already have PV ratio. So break-even point in terms of value will be fixed cost, which is 1,20,000 divided by PV ratio, which is 0.666. We calculate, we will get rupees 1,80,000. Break-even point in terms of quantity will be, so break-even point in terms of value divided by the selling price. That will give us 12,000 units. That is the solution for this. Let us move on to the next question. It says, question 2, it says a single product company sell its product at rupees 60 per unit. In 2010, the company operated at a MOS of margin of safety of 40%. The fixed cost amount to rupees 3,60,000 and the variable cost ratio to sales was 80%. In 2011, it is estimated that the variable cost will go up by 10% and the fixed cost will increase by 5%. Find the selling price required to be fixed in 2011 to earn the same PV ratio as in 2010. Then this is first question. Second question is, assuming the same selling price of rupees 60 per unit in 2011, find the number of units required to be produced and sold to earn the same profit as in 2010. The first, let us consider 2010. It says, given MOS is 40%, that means our break-even point will be 60%. Selling price per unit is given as rupees 60 per unit. And then fixed cost is given as rupees 3,60,000. Variable cost ratio is given as 80%, which implies that our PV ratio will be 20%. Now, from this information, we can find out variable cost per unit will be selling price, that is 60 into 0.8. So we get variable cost as rupees 48 per unit. Now let us go to 2011. Variable cost will increase by 10%, which means that variable cost per unit will be this 48 multiplied by 1.1. Then it gives fixed cost will be increased by 5%, it says. Increased by 5%. So this fixed cost will be now 3,60,000 into 1.05. Okay. If PV ratio is to be the same, but there is an increase in the variable cost, then if the PV ratio has to be same, then selling price has to be increased by 10%, which means that our selling price should be rupees 60 into 1.1, which will become rupees 66 per unit. Now, if I have to find out the selling price, already we found out the first part of the question. Find the selling price required to be fixed in 2011. That is done. So this is the solution for it. Okay. Then it is also asked in the question, assuming the same selling price of rupees 60 per unit in 2011, find the number of units required to be produced and sold to earn the same profit as in 2010, which means we need to first find out what is the profit for the year 2010. Again, going back to 2010 to find profit. To find profit. We know break-even point is fixed cost, that is 3,60,000 divided by PV ratio. So that is 3,60,000. We know in 2010 the PV ratio is 20%. So 0.2. So this will give us 18 lakhs, which means sales should be break-even point divided by the break-even point in terms of percentage, which will give us 18 lakhs divided by 0.6. That will work out to 30 lakhs. Let us see. 30 lakhs. Now we have another formula wherein we can find out the profit, that is sales is equal to fixed cost plus profit divided by PV ratio. So which means 30 lakhs will be equated to 3,60,000 plus profit divided by PV ratio is 0.2. That means our profit will be this multiplied by this, means 30 lakhs into 0.2 minus 3 lakh 60,000. If we calculate that, we will get the profit as rupees 2,40,000. Sorry. We are supposed to find number of units to be produced and sold. To have the same profit, which means it is fixed cost plus profit divided by contribution per unit. So that will be 3 lakh. See, for 2011, the fixed cost is 3,60,000 into 1.05. Plus, we just calculated the profit, 2,40,000. Contribution per unit is selling price minus variable cost per unit. In 2011, variable cost per unit is 48 into 1.1. That if we calculate, we get 85,833 units. So that is the solution for this question.